I'm not afraid of missing out on opportunity. I'm
Mm.
afraid of losing money, right? My own or other people's money. So that's how I approach deals, and it makes it harder when the market is really hot. It makes it very hard to find deals because you can't build in any margin of safety. Now it's hard, because it just sellers are unrealistic, and the debt is out of control. Not out of control, but the price of debt is high relative to where the pricing is.
Sure.
So it's hard to make deals pencil.
Something we talked about probably 2 years ago, might have even been close to 3 years ago, with Jonathan Twomley was moving on from multifamily because he could not find a deal. And he started looking at boutique hotels. He's now had experience with at least a couple of them. So I thought we would check out on his thesis, see what he's doing, see how they're performing, and just see what's what. How you doing, Jonathan?
I'm doing great, Michael. How are you today?
I'm doing very well. So a lot of people are talking about boutique hotels lately. I see it across my Instagram feed. But you were the first one to go do it. I think it was 3 years ago or so. You got the first one, and I think you've added a second one since then. Why don't you remind me of your thesis and why you went to boutique hotels when you couldn't find multifamily deals, and we'll check in on how you're doing.
So, yeah, I mean, it really is one of those things that I didn't plan. Like, I didn't go and say, hey, I'm looking for another asset class. How about hotels? I think because I was like a lot of people who thought like, oh, hotels are really risky. When the economy is bad, they're bad, and the stability of multifamily is better, and I'm more interested in that. It wasn't really a kind of any deep thought process, but what it resulted from was a couple of things. One is, as you said, like I couldn't find deals that made sense. 2020, 21, 22 was kind of sitting on my hands. I had kind of raised some capital for a couple of people, but just was not really comfortable with where the market was. I just couldn't find any value. And I'm just like a value guy. Like, I'm not the kind of person who invests on momentum. Like, I don't invest on like, oh, the market is hot, so I want to get in and flip deals fast and make money fast. Like, that just always struck me as being just way too.
Oh, it's gambling.
Yeah, it's gambling. You're just betting on things continuing the way they are. And we've seen how that worked out, right? So I had been looking for other things or looking for other markets. I started looking in places like upstate New York for apartment buildings to see what was around. But there too, it was pretty much the same thing. Things felt very overpriced. And just wasn't really willing to pay the freight. So as I was looking for not for hotels, as I was looking for multifamily assets to buy, I came across this hotel. And the hotel for me personally had a little bit of a backstory, because my wife and I, up until recently, we just sold it, but we had a house up in the Finger Lakes in New York State. And to go to our house, we would always pass this one particular hotel. And the hotel was just in this spectacular location with this amazing view. And every time we passed it, and it was just run down and kind of junky. And we'd say, man, what a shame. Somebody really ought to do something with this place. I can't believe that this kind of crappy old hotel is in such a great location. Plus, I knew that the market was very strong in that location because there's a state park a mile away that gets 1 million visitors a year. It's actually, I think, up to like 1.4 million a year for that state park. So I knew that there was a lot of demand there, and this hotel just seemed like a great opportunity. And when I saw it on the market, I also had noticed that it was been on the market for like a year, and they had cut the price over and over and over again. They started out at 3 million, they were down to 2 million. And I thought, okay, this is kind of interesting. So I decided to look at it. And then once I did, I liked what I saw, but I didn't know anything about hotels. So I was like, okay, I got to find somebody who knows something about hotels. So I asked a business partner of mine in something unrelated to real estate, who happened to be Indian. And as you probably know, like Indians are very big in the hotel business. So I just asked him, like, hey, do you have anybody that you can recommend who's like an expert on hotels? And he said, as a matter of fact, my cousin has a hotel management company. You should talk to him. So I showed him the deal, and he was like, oh, this is really interesting. And we've also done things like this already. Like, we've done 4 or 5 of these kind of heavy repositioning deals before. And so we decided to go for it. And I found, one investor to do the whole thing. We did it all cash. I didn't want to take the risk of like getting debt on this. So we paid for the whole purchase plus rehab in cash. So once I did that, I kind of started thinking about like, so we did the rehab. I'll get into that a little bit later about what the results are, but this is what comes to the thesis. So I started thinking about like this experience, who we bought this from, and what the circumstances were. And what the circumstances were this was an elderly couple that, were in their 80s. The husband actually passed away while after they put the thing on sale. The kids didn't want to run it, right? And like I knew from, you probably see this all the time, but like, baby boomers are retiring. They don't have people to take over their businesses. A lot of people see that there's an opportunity now to buy some of these baby boomer businesses that don't have any successors. Well, the same thing is happening in hotels. And a lot of times you have these older assets that were kind of like the first hotel in town. So they have the best location, right? They're right downtown, or they have the spot with the view, or like whatever it is, because they were there first. But now over time, their family businesses, they don't really put CapEx into them. I think especially in like the last couple of decades, it's been very hard for operators like that to get debt to do rehabs. So my thesis was that there are a lot of these owners who want to retire, and there's, their kids don't want these things. Plus, there aren't a lot of investors who are interested in them because of the condition. Right. Yeah. There's a lot of hard work that needs to be done to bring these assets back. But what they have that's unbeatable is often A, the location, and then B, the architecture, right? Because they're not just a box. Like almost all the hotels that people stay in these days are a corporate box, right? It's the same thing everywhere you go. And that's fine for business travel when you're just like on the road and you just want to like, there's something that you just like, I know what this is. I'm a loyalty member. I just want to go here, whatever. Right. When you're traveling to a destination for like a vacation, you want something that is more memorable. You don't want to just stay in a box. I mean, obviously, everybody's different, but there are lots of people who don't just want to stay in a box. They want to stay in someplace unique. So I realized that if you kind of like put all those things together, retiring baby boomers, lots of CapEx needed, great locations, that there is an opportunity here to buy assets really cheap that you could then bring back through a rehab. So that was the thesis. And so
let's break down the first deal, right? Because again, I think it's very interesting because again, you saw a lot of the things that you saw in multifamily 5, 6, 7 years ago or 10 years ago now. You had an operator that was ready to exit. They were long in the tooth. They had it sold, so it was on market, been on market a long time, already reduced 33%, right, from 3 million to 2 million. I'm guessing you didn't pay $2 million. Or did you offer something less, or what did you?
We wound up paying slightly less than that. So I think it might have been, maybe they had it was on sale for like 2.1 million.
Okay.
We agreed at 2, and then we found some stuff during due diligence, and we asked for price reduction. So we got another. They did a $50,000 concession.
All right.
So we wound up getting it for slightly under 2.
And then how many? I'm going to say doors. Maybe it's rooms. Maybe rooms.
So there were 40, but 10 of them were offline. They hadn't been used in years.
Oh wow!
And so we decided to take those 10 that were offline and turn them into. We were able to make 7 suites. Some of them we had, because of the way the construction, the firewalls ran, we couldn't. Originally, we were going to make 5 suites, but we wound up making. How does it work? I forget the math. But the 7, there were 10 rooms that we got 7 rooms out of them. So it was like 3 singles or something. I forget how the math works. 3 suites, maybe 3 suites and 3 singles are still there. So
gotcha. Okay.
Yeah.
All right. And then sounds like you had a single strong investor to be your partner, and this was great. But you also said you borrowed the repair money. Did you have? What did you estimate?
We didn't borrow the repair. We funded the whole thing.
Yeah, he funded the whole thing, right? So he did the purchase and the repairs.
Yeah. So So
How
yeah,
much was
so we
that
were
roughly?
all in purchase price plus rehab plus all of like our fees and stuff like that was about 3.8 million in total.
Oh wow, so that's a heavy lift.
Yeah.
That was
Yeah.
over $1 million in
Oh yeah. Yeah. I
remodel.
mean, there was a big restaurant. There was external work to do. So there was, there was actually a restaurant, a second bar, the lobby. So a
Oh
lot of the
wow.
money went into that. And then there was the rooms. And then there was, we had to also, um, it turned out that the pool was not in repairable shape. They had been doing like really sort of quick fixes to the pool just to keep it going for years and years and years.
Yeah.
But when we got into it, it just was clear it was long gone. When we tried to get estimates to replace it, it was just insane, like how much it would cost to replace it. So we got creative and decided, we asked like, hey, do people actually use the pool? And the previous owner was like, no, people don't really use it. They just like to sit by the pool and look at the lake. So we're like, okay, why don't we just put a deck out there,
right,
so they can look at the lake? And so that's what we did. So we built a deck over the pool, and wound up with the biggest, so this huge deck overlooking the lake, which is now actually the biggest deck in the entire region, apparently. So we still have not really monetized it successfully yet, but it is going forward will be something where we try to host weddings and things like that. So yeah.
Very, very cool. So you closed on this, was it 2022?
2022. That's right. Yeah.
So you've had it, it probably took a year or so kind of bringing it back to life?
Yeah. So one of the big things I learned on this was that these projects just take a lot longer to get to sort of stabilize them than you think. The construction is actually the relatively easy part, right? I mean, there's always, as you know from the other hotel too, like there's always like, stuff with the town and stuff with the vendors and things like that. But in the grand scheme of things, those delays are not that material. Like they feel really bad at the time. They're like, oh my God, we're delayed 2 months. And you're like, holy crap. Like, all my investors are going to be mad at me. But in the grand scheme of things, that's not really what takes time. What takes time is reestablishing the hotel's like reputation in the marketplace.
Interesting.
Because people, I guess, problem, but also opportunity with these hotels is because of the way that they're run before, and it's funny, we see the same pattern. I've seen this in these hotels, other hotels I've looked at. When you look at these hotels, they all have the same decor, and that's because they all did a rehab like in the 1990s. So they all have the same. It's like the same floral print carpet. I mean, it's amazing. So there must have been some standard package that hotels were buying in the 90s, right? And they haven't done any capex since then. It's just been like the minimum viable maintenance that they do just to keep things running, right?
Sure.
So, and because these hotels have, I mean, oftentimes they're either the original owner who built them, they have no debt, they have no basis in it, or their children who have inherited it. They can run these things, they don't really care that they're not getting top room rates. They just kind of want things to be easy, right? And they're running things on a lifestyle. So you look at the reviews on Google and TripAdvisor and stuff, and the reviews are usually pretty bad. There's like some small core group of fans that like it because it's cheap and it's convenient, or it has a view or whatever.
Or memories or whatever.
Or memory, yeah. Or like we've stayed here every year for the last 30 years, and they kind of, it's the same for them. So they don't really notice that it's sort of like slowly getting worse and worse and worse. But then you read the reviews from like the people who stayed there once and would never stay there again, and it's like the carpet is sticky. You know what I mean? Like it's like the bed is, like a rock and lumpy. It's like a lumpy rock. It's like sleeping on gravel. I mean, it's like, so, and people, one of the things I realized, like I kind of thought like, hey, if you go and you put a new name on something, people are going to realize it's different. And that's not enough. Like they need a couple of years to like,
they need to see it.
They need to see it. They need to really see it and believe that like, oh yeah, no, this is totally different. Right. And
Yeah, because again, I mean, the people were driving by it just like you for years, going, "Oh, wouldn't it be nice if somebody did something with that?" And
Yeah.
they just remember it year after year after year, kind of not being the spot.
Yeah, and even changing the name, changing the signage, repainting the entire exterior, like people still, unless they go in and they stay there, they don't know it's different. And then, of
Gotcha.
course, then you also have to, in a way, it's sort of like re-tenanting a property,
Mm-hmm.
where what you wind up getting then is also a lot. You have to really change the guests who are coming as well.
It's just like
Yeah.
moving a C property to a B, is you have to re-tenant, and that's the hard part.
Yeah.
Right? Yeah.
And what happens is then you get a lot of people complaining that the price has gone up. And
Yeah.
you're
You
like,
lose
well,
the last ones that were, yeah.
yeah. So you lose the old customer. I mean, not all of them, because some of them are like, oh, this is great. We're so
Yeah.
happy that you did this. But there are a lot of people who like, because they wanted to pay $100 a night to stay there, and now you're charging $250, $300 a night,
Right.
and they're not happy about it. Or they're like, why did you get rid of all of the old auto racing decor? And we're like, well, because the family that sold it to us wanted to keep all their memorabilia, so they kept it. That's one reason. But another reason is we didn't want it anyway, right? Mm-hmm. Because we wanted to change we want to change the look and feel of the hotel. So
there you go.
So it takes time. So it feels like last year we had a good year. It feels like this year we're finally kind of hitting our stride with that hotel. So we're finally kind of getting close to what we had underwritten for.
Would it be fair to say it took 12 months longer than you initially thought?
Yeah, I would say. I mean, 12 months at least, maybe even 24 months. Because I think I did think like, well, as soon as we finish the rehab, everyone's going to flood in. Yeah. And it doesn't happen that way. It's sort of like a year for the rehab and then a year for the market to kind of absorb the fact that this is a new asset. And then like in the third year, now you're starting to really reap the benefits of like the couple of years of hard work that you put on. So I think there still is a lot of value to create in these assets, but it takes longer than I thought it would take.
Okay. All right. Well, that makes sense. I'm curious, when you look at that first deal with your partner and you kind of pencil out a new value, I'm going to guess you're ahead, right? Because again, you're into it for 3.4 or 3.5.
I'm sorry, when you pencil it, what do you mean by that?
Is it worth more than you've invested?
I'd say it's probably right now worth about what we put into it is my guess. But that being said, I mean, we did actually get a broker BOV for $6 million.
Oh, okay.
But
that's more.
But it's it's a lot more. I mean, but it's a broker BOV. Like, I'm just not sure, honestly, like who would pay us $6 million for this asset right now? Because we're not quite there with the cash flow. We need like a couple $100,000 more of.
Well, again, I think your plan originally was at least five. It had to be at least 5 years.
Yeah,
it had to be. Yeah.
Okay. Yeah. So we're. I mean, listen. If we were to, I don't really want to sell this hotel, kind of ever. But I mean, if somebody were to pay us $6 million 2 years from now for this hotel, I'd feel pretty good about that. So
okay, very cool.
Yeah.
Well, sometimes something's good, more is better. I think you were about a year into this when you kept looking around and you found another hotel in roughly the same area, or what's the story there?
It's about 4 or 5 hours to the east. It's in Vermont, so it's not really the same area, but it's a similar sort of market. So it's it's a weekend summer destination market. It's actually, I mean, the one in the Finger Lakes is not as close to major metros. The second one we bought is in Vermont, so it's where the location is. It's like 2 hours from Boston. 3 to 4 hours to New York City, depending on what part of the city you're talking about. So it's basically within a couple hours drive of like, I think it was 50 million people.
Oh, wow.
So there's a big market to draw on. So that hotel was a very similar situation. It had been both of those hotels started out as restaurants. And then they added a hotel to it. And then the hotel kind of took over and became the main business over time. It was still owned by the family that built it. But in the Vermont case, it was the son who was running it. And they had been trying to sell it, and they had actually fallen out of contract at least once, maybe twice. And so by the time I actually saw it, I like the asset because it has really cool mid-century modern architecture, and it has these amazing gardens, and it's the only hotel that's walkable to the town of Bennington, which is in Vermont. And so there are a number of other hotels in town, but really none of them, either they weren't walkable to downtown, or, the view is of a parking lot, they don't have the gardens. They just didn't have the kind of like amenities that this hotel has, and the opportunity that it had, plus the unique architecture. So by the time I'd seen it come on the market, I kind of like thought about it. And then it went into contract, and I was like, oh, that's too bad. I missed out on that. And then I saw it come back. And so I was like, okay. So I called the broker the same day and started working on that deal. And like I said, very similar story. And we wound up, because it had fallen out of contract, they were very reasonable about what they were willing to sell it for. So we wound up getting it for $26,000 a room, which is super cheap. Okay. And we needed to put another all in about 30, wound up being about 30,000 a room. I mean, a lot of that went to exterior. It goes to signage. There's just a lot of other things that go into that number. So it's not all in the rooms,
right?
But all in for that asset were, I think, 55,000 a door.
Okay.
Compared to like the most recent sale, which is after us. So not, this isn't like top of the market, 2022 pricing. This is 2024. Actually, it might be in 2025 that they closed for more than 100,000 a door. And that was for an asset that needs renovation. So we're like $55,000 in, finished, renovated. And, so we're still in that phase of like just trying to get the business itself running and caught up. And we're still in that phase of like, okay, the rehab is basically done, but the market doesn't really
it doesn't know yet, not aware.
We had, during construction, we got some bad reviews that we had to take care of and things like that. So we're still in that phase of like, okay, rehab is done. Now it's the first year post rehab where we're like reacclimating the market to this asset, letting them know that this is like a totally different hotel. But we also know that, hey, look, we've essentially got $45,000 a door of built-in equity if the sales comps are reliable, right? So that makes me feel good, even though the hotel is still kind of in that kind of dragging phase. We also, on this one, we have a Wyndham franchise agreement for this hotel.
Well, you also got seller financing, at least for some of this one, right?
Yeah. So we also got like 70% seller financing on the purchase for this. We funded everything else out of equity, the whole rehab. But yeah, I mean, the seller, they were very opposed to the idea of seller financing at first, because apparently years ago when they sold off the restaurant piece of it, they sold it to a developer with seller financing and wound up having to take it back. And they were kind of scarred by that experience, and were very concerned that they were going to have to take this hotel back. And what they got was like a demoed shell back from the developer, right?
Of course they did.
Right? So they were very wary about this. And we kept on trying to explain to them, like, look, we have the money to do the rehab. Like we have experience. We have a lot of experience doing this between me and my partner. Like, this will get done. But they were very anxious about this. But we finally got them to agree, because there just was no bank debt available. Like, was not. There was nothing available, and any kind of like private money just made the deal untenable. So any kind of bridge debt, hard money lending. So
how long did they give you? 5 years, 10 years?
5 years, actually, which is great. Thank goodness, actually, because even 3 years, I mean, we would be kind of, next year if we had to refinance, it'd be a little sticky. But right now we're talking about, and again, depending on how you value that hotel, I'd say just like on a sort of cash flow basis, we're probably it's probably worth what we put into it at this point. However, if you use a comp sale, right now we're talking almost like doubling our money. So I don't think refinancing will be an issue not in 5 years, or like, so we got what, three years left of seller financing. So I don't think that we're going to have any issue refinancing that, because at that point it's going to be worth, like, the loan will be 25% of the value of the hotel at the most, so it shouldn't be hard to refinance.
Nice. So what have you learned? Are you going to be a boutique hotel guy going forward, or are you just licking your chops waiting for multifamily to come back and you're going to make these just two different ones? Or what are you doing?
I mean, I think I would like to do both going forward, but I do just on a like, what do I do day to day kind of basis? I find the hotels to be a little more interesting, because the rehabs are more fun. There's the multifamily stuff is very basic, like rehab's very basic. It's kind of like, there's a lot more sort of creativity that goes into.
Yeah, there's more design options, right? I would guess
more design options, choices, thinking about the amenities, thinking about the name, there's just a lot of things that go into it. And then the kind of like the day-to-day operations are a lot more like, my partner is the one who really is in charge of the day-to-day operations, but we're constantly talking about it, and I'm making the high-level strategic decisions. And it's like, you've got to be a lot more agile with a hotel than with multifamily. And that both makes it challenging, but also makes it more interesting. And there's a lot more like playing around with pricing and seeing how the market reacts, and like what happens if you give a second night off for 50% off, or like you run a promotion. And we run all kinds of like fun promotions. Like we haven't really done this at the hotel in Vermont yet, but in the one in upstate New York, like we did really well in the middle of the winter we ran a cabin fever promotion. Like, just get out of the house and go somewhere. I know it's the middle of the winter, the weather sucks. And this is really aimed at like local people, but it was like cabin fever, just get out of the house and come stay at the hotel for a weekend. Right. And
nice.
It worked, so you can do stuff like that, whereas you can't really do that with a multifamily property. So that being said, I feel like I've actually learned a lot, because when I did multifamily, we never did any like real deep rehabs like we've done with these properties. Right. And I feel like now, like, oh, you know what? I could now take on like a real
big
like distressed, like really distressed multifamily property that just needs a complete, gut. Like I could do that now, whereas I couldn't do that before. That's really thanks to my partner. My partner is the one who had the experience of that. But I feel much more confident now being able to tackle a project like that, and also being able to underwrite it and then sort of know a lot where more like the pitfalls are that you run into. So, and
then you mentioned in the second one, you got a relationship with Wyndham. How did that come to be? Is it a net positive? What's that all about?
Yeah. So we started thinking, once we purchased the hotel, I mean, they were very aggressively kind of courting us, but
so Wyndham was courting you.
Yeah.
Okay.
Because they're on a big push to like increase their footprint in the Northeast.
Okay.
So they were very interested in what we were doing with this hotel. They didn't have a presence in that market, and basically put a lot of like key money on the table for us, which made it possible to move forward and kind of wrap up the rehab for us, and then also put some money into the reserve fund. So that's been very helpful, but also it's really, we've actually seen the uptick in traffic that comes from having being marketed by Wyndham.
Sure.
Right. So, so that's been also beneficial. And so, I started out being very skeptical about brands, because I had, former life spent a lot of time litigating against hotel chains, and really thought that they were kind of evil. And now I've changed my mind. I mean, I don't believe that anymore. I think there's a lot of they can really help out, the hotel a lot by having that relationship and being part of the loyalty program, right? And then
Sure.
the other thing too is it makes having the franchise agreement makes refinancing a lot easier. Like it just puts you into a whole different
category.
of debt, right? And so, especially on this hotel, like by the time we go to refinance, we'll have 5 years of operating history. We'll have 3.5 years of Wyndham Wyndham franchise agreement operating history with 17 years left on the contract. So it's like that's going to make it a lot easier to refinance. Even though I wasn't concerned about the refinance before, but this will just give us a lot more.
Help you lower rates, worst case.
Give us more
better
options.
Better debt.
And get better debt. Not just relying on like a local bank or something, but being able to go to like a CMBS or something like that, which is going to give you better terms. So
very, very cool. Well, I think on this second deal, unlike the first one, you had a big money partner you were in it with, but this second one, you actually went out and did your syndication.
I did. Yeah. So we I think there's 41 investors in that deal, including me and my partner, but all together. And so we ran the full syndication on that. And the thing that surprised me about that was I was a little bit wary. So this is 2023. So it's after the peak has passed, interest rates are up. And I was very concerned about trying to raise money for something like a hotel where the perception has been, or I think not based on anything in reality, but just I think a lot of investors are like, oh, it's riskier. And what I found was that a lot of investors, we didn't have any trouble raising the money really. And I think the reason was because a lot of investors are done with multifamily. Even if their deals were still performing well at that time, they were like, well, I have enough of that. I need something else.
Well, it's the story. I mean, that was something that was different, right? Everybody else was all they could tell us was the cap rates were going to be lower on the exit. And it's like, that doesn't make sense forever.
Yeah. I mean, that was the story too, in terms of like the value proposition, right? The price that we were buying it at, the comps, the position, like the deal itself was a good story, right? Not just that, like the underwriting was realistic. I mean, it was very conservative, and then the not just that the underwriting was realistic and the exit assumptions were realistic, but that the story itself was good. But just talking about like conservative underwriting, right? I mean, when people throw that term all around all the time, but I want to point out, like on this asset, when we pulled the market data, which you can buy from, there's a professional market data reporting service for hotels. We pulled the data. We found that this market was basically, so year round occupied at 59%, like 59% occupancy for the year round, right? I underwrote that deal at 38% occupancy.
Oh, wow.
Rising to 44. Like I never went above 44%. And like, that's what conservative underwriting means. And at those numbers, the deal was, like the projected exit at those numbers at like an 8 cap, exiting at an 8 cap is $7 or $8 million. I don't remember off the top of my head, but like I actually didn't use the market occupancy for my underwriting because the numbers were so good. I didn't think anybody would believe me.
You didn't need to set the bar so high.
Yeah. I was just like, nobody, this looks so crazy. And also like, I just didn't want to do that. I was like, I don't want to set myself up for like disappointment by saying, oh, we're going to make this much money. Like,
well, that's one of the things that I find about you, again, being conservative. Again, you sold a bunch in 19. You didn't do any deals when it was crazy, right? You don't let momentum. You're always conservative, which means you lose out a lot in a hot market, but it also means you set up your LPs for success, and surprises to the upside, right? So a lot of these syndications that were coming my way were like, yeah, that's like the best case scenario of, unicorns and rainbows, right? Tell me the other side.
Yeah. I just always, my concern has always been about not losing money. right? Like
That's a good thing to say. Yeah.
But I mean, but that's honestly what keeps me awake at night. Like I'm not afraid of missing out on opportunity. I'm afraid of losing money, right? My own or other people's money. So that's how I approach deals. And it makes it harder when the market is really hot. It makes it very hard to find deals because you can't build in any margin of safety. Now it's hard, because it just sellers are unrealistic and, the debt is out of control, not out of control, but the price of debt is high relative to where the pricing is.
Sure.
So it's hard to make deals pencil.
It's coming though.
That will change.
It'll change.
It's coming.
So I'm curious, when you look at your week or your month, however you count your hours, I'm curious when you're looking at deals, which I know you do a lot of still, what % of your time is hotels versus multifamily today? Just curious.
I'm probably spending more time actually looking at hotels. I haven't really tracked. I don't really know what the
I was just
numbers would
curious.
be. Yeah, because I'm probably still more actively looking at hotels at the moment.
Well, I think it's also the other thing I think you learned from this is you still have a bunch of baby boomers who own these hotels who maybe built them or their kids have them. That's probably not the case with multifamily. Multifamily got picked over a bunch in 21 and 22.
Yeah, I don't think not just 21 and 22, but really over the entire last cycle. I feel like when I started buying multifamily back in 2011, but really started closing deals 2013, 2014, 2015. The owners of those assets were like those mom and pop owners. That's who was selling.
That was a decade ago. Okay.
Yeah. And I don't think that, at least for the bigger multifamily deals, for those like 100 and up, the 100 and up unit deals,
I think so.
I don't think a lot of those owners still exist. I think they've mostly sold out to syndicators, and so those bargains don't exist anymore. Maybe for some of the smaller assets they do, but for any of the larger ones, I think that stuff has all been pretty well traded. And maybe here and there you find something, but for the most part, I don't see that opportunity is already passed for those bigger deals.
Yeah, I think so too. Yeah. I think so too. Well, Jonathan, you do amazing stuff. I look forward to seeing what you can find or create going forward. If somebody wanted to reach out and learn more, maybe get on your list, what do they do?
Yeah, just the best place these days is LinkedIn. But you can always search for my website, Two Bridges Asset Management LLC. Just Google that; it'll pop right up. And I'd love to have a conversation with you on LinkedIn, or you can fill out the form on my website and join my list.
Thank you, buddy. Take care.
Absolutely. You too.